Well, guess what happened again, guys? YieldMax ETFs are now being liquidated. We just had Rex shares liquidate about 4 or 5 different funds. And guess who joined the bandwagon again? YieldMax liquidation. Welcome back to the channel. I'm Doug, the retirement guy, and we have to give you the update notice again about liquidated ETF funds. These high payouts, high risk investors are really paying the price. Okay? Don't chase yield. Protect your capital. Do your due diligence. Always look out what's going on here. And I'm going to break this down to you and give you guys the insight of what's happening. This just got announced prior to the weekend, and it's really starting to hit home of what's going on. So let's get into the video so we can try to help save some of your capital down the road. We do have to do the disclaimer, and that is past performances don't guarantee your future results, and this information in this video is for educational and informational purposes only. I am not a licensed financial advisor. I am just one who has been studying this stuff for years. The example and suggestions discussed here are basically not suitable for all individual situations, so always contact a financial advisor before making financial decisions. So for a lack of a better word, this is what I use. It's the income ETF shakeout. There's closures, there's liquidations, YieldMax, Rex shares, and the fight for assets under management. A wave of ETF closures is reshaping the income investment landscape. I'm going to break down which funds they're shutting down, why it's happening, and how to identify the next at-risk position in your portfolio. You look on the side, we have a bull market and a bear market almost equally into the same market conditions. You got YMAX, YMEG, both of them closing down. Okay, you got JEPI, SCHD, you got DISO, all of them closing up over periods of the same period in time. So it's something weird in the marketplace, and these weeklies are really taking effect. And when I started really analyzing what happened with Rex shares even deeper after the announcement, and then getting the announcement of YieldMax, I almost want to say now I agree with everything that I've said on the channel before and what people have left in comments, that they're done with YieldMax. They're done touching it. They're done playing with it. And I think, unfortunately, Rex shares is going to get the same image that YieldMax has, that both of them are just not out for us investors. They're really out for, of course, themselves, but not helping get this thing on the right trail. So let's get into what really happened. YieldMax consolidates 4 ETF closures. Now, this was not a performance failure. It's a demand and an AUM, the assets under management issue, cutting dead weight to focus on their winners. So here's the funds. ABNY is the Airbnb strategy of the option income ETF. That's being shut down, closed out. DISO, the Disney Strategy Option Income ETF, closing. The Featured 5 Option Income ETF, and then the Hybrid 5 Option Income ETF. They're all going away. YieldMax manages nearly 60 different ETFs. So these closures are reflecting the strategic consolidation, not a collapse. So I will give them credit there that their funds actually were not collapsing. Their strategy seemed to be working to a point, and I want a big asterisk there, to a point. So I'm not saying these funds have just actually collapsed. It's just they have no market, no investor interest. I remember when ABNY came out, the Airbnb, I'm like, wow, you could do Airbnb and be in an option income. This is interesting. And then Disney, I'm like, wow, this could be a big player, but why would you just not buy the Disney stock? If you want that, buy the Disney stock, collect a smaller dividend, and work accordingly. And so I was already questioning these to a point. That's why we really didn't promote these. We didn't really talk about these because they were just single stock issue items. Now, I want to give you the dates, the key dates to remember. June 15th, 2026 is the last day these funds are going to be traded. So your exit on your own terms. Before this date, it's best to liquidate the funds, get rid of them, get done. The final liquidation date will be June 18th. So anyone who still holds it after that 15th are basically going to go into auto liquidation, cash return to your brokerage account, clear you out, you're done. The best practice for this is exit before June 15th to avoid any liquidity concentrates or anything happening. If the fund drops off at the end, there's a lot of things that could go on. Get out before it stops trading on the 15th. Now, the risk assessment. Why, and the question is, why are these funds being eliminated? Why did they say? Do we care? Does YieldMax really care about the investor? Well, what I'm finding right now, when we did a breakdown of the REX shares, when I did a breakdown of these particular funds, I started finding out some common pieces that are falling in together. And here's what's really coming about to this. Assets under management, and we've talked about this every time I break a fund down or suggest a fund or do anything at all in the funds. I always tell you, assets under management can tell you what's going on. If you remember back when we did the ULTY videos, and I saw the assets dropping, I said, guys, be on guard, be on guard. And a lot of people would make comments like, no, it's doing a great fund, and it reverse split. It's because assets under management controls everything. When you're at $100 million, you're really at low risk. And a lot of people will say it's stable and growing. If your assets under management are growing, I can agree with you that stable and growth is there. When you get in that $50 million to $100 million range, it's moderate risk. You got to look at the fund and say, are we going in the upside or did we plateau at this? Same thing at 25 million to 50 million. Now your risk is becoming a little bit, a rise. That what's happening? Because you need money coming into the fund so they can invest it properly, they can get it out there, and the cost factor to run these funds, even though they're charging that 1% management fee. They need new money coming in on a regular basis. So the assets under management has to continue to get bigger and bigger and bigger, which is showing interest that they're selling more and more shares. When you get under $25 million, this is where the high risk, the liquidity starts to kick in. This is an area that you're like, whoa, hold on here. What's going on? You add time into this. So I'm not saying a new fund starts up tomorrow and it has $1 million in assets. Am I immediately in the high risk? Well, of course you are, but it's also you're rating it that it's a new fund. This is why I always tell everybody you don't buy right off the bat. You wait 6 months, wait 12 months. Don't have that FOMO, that fear of missing out. Let the train slowly leave the station. You can always catch the caboose. You can always catch it at the end. But also, you're looking at this and saying, I want to see what's the interest. And I don't want the YouTube guy out there, and I know I'm one of them, but I don't want the YouTube guy out there saying, oh my God, this is the greatest fund ever. This is so great. And everyone starts to buy it. And then once they stop promoting it on YouTube and move to the next big, exciting fund, nothing happens. The assets under management stops moving. So the danger zone, based on the observed closure from YieldMax and REX shares, funds operating below $25 million in assets under management consistently face that liquidity problem, that liquidation side of it. The fee, the revenue simply cannot cover the operational cost at this scale. So it's, again, even though they're charging big 1%, 1.1, 1.2%, They are not making enough money on the funds to have someone either managing it or someone operating it or anything like that happening. This is when they turn around and say, okay, there's no interest, move on. This is another part when they add so many new funds that we have to say, why? Why did you add a Disney when I could just easily buy the Disney stock? Why did you do Airbnb when I probably could just buy Airbnb stock? Now, here's what I want to show you. The YieldMax consolidations, the 4 funds that closed, ABNY, the Airbnb, the assets under management was at $5.38 million. Even though their yield was cranking out 48%, their growth was down 13.54%. Okay, so that really still gave you a good 35% return from your money. So there's a lot of people saying, oh my God, this was doing great, but nobody was buying the new shares. Disney was even worse. $4.84 million in assets under management. And these funds have been out there, I almost want to say almost a full year already. And you look at yield, 43%. So again, when you yield chase, when you're out there looking at yields, oh, look at this, 48, 49, 43. That doesn't matter. That doesn't give you security. Look at the assets under management. This is why we continue to talk about assets under management, the yield, the growth, the total return numbers. These are all the pieces that you have to look at in the particular fund to see if it's going to be there long term. Even over here, $13.16 million in FEAT, the featured 5. Big yield, 85%. Down 24. So still some positive numbers, but you're still below that $25 million mark. Now, again, the big winner spotlight, the NEOS and Roundhill categories. Okay, QQQI is over $12 billion in assets under management. And it's been stable. It's continued to grow. It's an index-based fund. SPYI, same thing, over $10 billion in assets under management. Now, am I saying that these type of funds could fail? Of course, every fund can fail. But if you continue to watch the assets under management, they just continue to slowly climb, and climb. And they produce decent income. They produce some decent growth. They do what they say they're going to do. So the scale drives survival. The market is consolidated around broad index-based income funds, and brand recognition is very important as of performances. Even super performing smaller funds risk closure without significant assets under management to sustain operations. Okay, so when we look at these funds, and off top of my head, I believe they're like 0.69%. Don't hold me to that, but we can always do the research. But 0.69, 0.69 of $10 billion versus 1% of $4 million, night and day difference of operation. It's like a waitress getting tipped on a $100 meal or a $10 meal. Big difference between the two, and this is what we're trying to show. So the single stock ETF danger. Niche funds tied to one stock carry a unique structural risk, and they're closing fast. Recently, the Rec Shares liquidations, the MicroStrategies, the Eli Lilly. Now, I personally owned that one, and I fall almost, I hate to say this, guys, but I almost fall into exactly what I'm going to explain here. But Eli Lilly, the single stock ETFs, both closed as investors' interests shifted. The investor, I call it the investor fad, okay? And I know it says investor fades, but it's an investor fad. It's you get excited about a fund, okay? You see it on YouTube. You maybe read it in Reddit. You watch the news. You hear Jim Cramer going crazy over a fund, or you just get some new exciting interest into it. A single stock ETF rises and falls with the popularity of the one underlying name. Okay, so when that hype just fades away, so does the assets under management. Now it either flattens out or does what we show you here in the pattern, drops completely off. I'll give you my example. Eli Lilly, when I first came out from Rec Shares, I was like, wow, this could be a really good one. A little bit in the healthcare side of it. Eli Lilly was talking about coming out with some new drugs and different things, and I got excited about it. And I jumped into it in our weekly challenge. I put it in there thinking this was going to be the great fun, down the road. Great strategy, great company with Rec Shares. Everything was golden. Shortly after that, guess what? We didn't hear anything from Eli Lilly. We didn't hear their drugs getting passed. We didn't hear anything from that. I personally even lost interest into it and got away from it, and off we go. Now, I don't promote on this channel. I don't push one stock or another. I don't even take the sponsorship that's been offered. I don't do anything like that because I want to be straightforward and honest with people what I do in my funds. The other thing, NAV erosion. The high underlying volatility eats into the net asset value over time. And that's accelerating the capital loss for us, the shareholders. We talk about NAV erosion all the time. And this also gets into the low liquidity. That thin trading volume makes it very, very hard for these issuers to make money. And you think about it, what are they here for? They're here to make money. I talk to people all the time about, oh my God, the expense ratios. And I always said, expense ratio is just all built into the pricing, the returns and all that. But it's also a part, if they're looking at 1% and they're only getting 1% of $5 million, $4 million, it's not a lot of money to put the manpower into all this. So you have to monitor your AUM, your assets under management, monthly. Think about this as, before you go on a major road trip. Do you check your tires? Do you check your oil? Do you, make sure your air cleaner's done on your car? Or you're getting everything's ready to go? You need to do this every month. Monitor your assets under management when you're under 25 million right off the bat. These singles an evaluated closure risk. If you hold a single stock ETF, and I cover this all the time on when we break down different ETFs and what's going on, pop underneath the hood. I always tell you what the assets under management is. Why? Because of this right here. If you hold a single stock ETF, you have to have the excitement from investors. You have to make sure you have no NAV erosion, and you have to make sure your assets under management is climbing to cover the cost it does to perform. The low trading value, and to set a monthly calendar reminder to check that AUM. If you see it dropping off, it's heading the wrong direction. It needs to be climbing. It needs to be getting bigger. Even slow steps will tell you, okay, we're still in the positive ring. So there's 4 different steps that you always look at. Again, the yield, the growth, the total return, your assets under management. They all tell a story what's going on with your fund. So in summary, research. Check the assets under management for every income ETF in your portfolio. Anything under $25 million, you mark it as a danger. Put it as a danger zone. I'm not saying sell it. I'm saying it's a danger zone. Start preparing an exit plan. You may not have to break the glass. You may not have to do your strategy, but you want to watch it. You want to monitor. Watch the gaps between management fee income and fee operational costs. Declining assets under management and lower trading volume are early warning signs that it may be time to exit the plan. And 3, rotate. Move capital towards higher assets under management. The index-based incomes, as I showed you, are growing. You don't need to stay loyal to a fund that the market is abandoning. Okay? You can't be sitting there saying the last man on the ship, holding the flag. The ETF boom is shifting from expansion to consolidation. We talked about this, kind of didn't really mention it, but when you take a look at weeklies, they're sitting over 165 different weeklies, and they were popping up every week. Brand new fund here, brand new fund there, 5 more funds brought up to this one. This one brings up another funds. It really made it difficult that how can 165 hold off on the brand new strategies. So I look at this and say the ETF boom is shifting from expansion to consolidation, prioritizing on scale, volume, and sustainability. These are the 3 things that I came from the past 2 warnings from YieldMax and RecShares that they're liquidating funds. Some of them not performance driven. Some of them just pure out loss of interest. Guys, this is not financial advice. You want to do your own research before making any investment decisions. This is what I read personally. This is what I'm doing in my portfolio. This is why I share it with you. If you like what I'm doing, please hit that like button. It helps the channel the most. It gets you reminded that we can continue to put these videos out. Best of all, if you're not a subscriber, hit that subscribe button. And also, put a comment down below. Put a comment down there. Tell me, are you into these funds? Are you getting out of these funds? What's your exit plan? I'd love to find out what my viewers are doing. I tell you what I do up front. Love to hear what you guys do.
Thank you for watching. Press the